Investing is one of the finest ways to enhance your wealth, but it also comes with the danger of losing money, particularly when choosing which firms to invest in. Let's break down everything you need to know before investing to assist you to avoid costly mistakes. Stay with me till the end to know my top 8 things to know before you start investing. Without further ado, let's get right into it. Number 1. Your financial goals. What do you want to achieve? Consider your entire financial goals before making any investment. Are you investing for your retirement, to purchase a house? Or for another reason? Is this an investment in general savings? What would you like to accomplish with this money, and how fast would you like to have access to it if you needed it? How much do you need this money to expand, and how readily might any losses be replaced? All of these factors and more will influence your financial strategy. Most investors' best bet is to create a strategy that includes long-term holdings, so you'll want a stock that will pay you over years rather than months. That's the overall rule. Make certain that your investment satisfies your requirements, not those of others. Number 2. Current portfolio mix. Risk. How many safe investments do you have? How many of these are risky, and what kind of balance do you want to establish in your portfolio? Before investing in any firm, think about how it will fit into the larger scheme of your financial risk balancing. This is something you should keep an eye on at all times. If a company's history has been highly erratic, this might signal a high-risk, high-return stock. That may be precisely what someone with a high-risk tolerance or a portfolio already heavy on indexed mutual funds and bonds needs to add some growth. If, on the other hand, you already have speculative assets in your portfolio, it may be time to consider adding some stability to it. Number 3. Current portfolio mix. Diversification. In addition, before purchasing any stocks, you should consider how many individuals and bundled equities you already possess. Diversification is one of the most important aspects of a good portfolio. Focusing on an S&P 500 index fund is frequently a great method for investors who don't want to play the game and have a reasonable length of time for their money to grow. It's undoubtedly preferable to leave all of your money in a savings account. If you're prepared to put in a little more effort, you can eliminate a lot of risk by spreading your money across a range of industries and asset kinds. If you currently own many tech stocks, for example, consider investing in a new company strategy rather than purchasing another. If you currently have a lot of equities and stock-orientated funds, try adding some bond or commodity funds to your portfolio. Having a diverse portfolio can assist you to ensure that your portfolio is better protected against systematic risk. Number 4. Dollar cost averaging. The SEC defines dollar cost averaging as a continuous pattern of adding additional money to your account over a lengthy period in its investing handbook. Instead of investing all of your money at once or in lump sums, you spread your share purchases out over time. For example, instead of placing $1,000 into a stock all at once, you may invest $100 every week for 10 weeks. The purpose of dollar cost averaging is to profit from volatility. Ideally, you will purchase more shares of your company when the price is low and fewer shares when the price is high, maximizing your profit. Dollar cost averaging is particularly useful for equities with moderate to high volatility. With a steadily growing equity, you generally don't want to use this technique because it's more probable that you'll just pay more for your stock each time you buy it. It can, however, be a winner with speculative assets. Number 5. Corporate leadership. What does the executive team of this firm look like? Before investing in a firm, consider who is in control. How much industry experience do they have? Have they been in charge of the company for a long period, or does the organization leadership change frequently? Are they well known in their field? How much attention do they pay to the company versus, for example, their social media account and personal celebrity? Strong leadership is necessary for every firm, but it's especially important for those seeking long-term stability and success. That's typically what you want as an investor, so keep an eye out for any possible red or green lights. Number 6. Business model and corporate history. Not to belabor the topic, but how long has this company been in business, and how well have they held up over time? Corporate history is more than simply a statistic. Although organizations with decades of experience will frequently give more consistent growth than new entrants, it's critical to remember that previous performance isn't a guarantee of future success, but it may also signal a firm that understands what it's doing and has ironed out the flaws in its business strategy. But keep an eye out on that business model as well. When a corporation has spent years fixing challenges and improves its routine, it might be an indication of a fantastic asset. However, the same history might just as readily reflect a company that is unable to grow and stay up with the industry. Before you invest, carefully examine your company's business model. It may prevent you from joining a sinking ship. Number 7. Price history and volatility. Of course, numbers are important. Just because they're at the bottom of the list doesn't mean you should disregard the information about how your firm has done in the market. Examine the pricing history of your preferred firm. How much does it cost? Will you be able to buy enough of it as a result of this? Keep in mind that when it comes to stocks, your profit is calculated in percentages. If you put $100 into a $50 stock and it rises by 1 point, you'll make $2. If you invest the same amount of money in a $5 stock, a 1-point rise will pay you $20. That's not to mean you should play penny stocks like a slot machine. There's a reason why high-value companies are more valuable. It's simply a heads up not to get too enthusiastic about purchasing a Google, Get Alphabet Inc. Class A report share just yet. While you're at it, keep an eye on the company's volatility. Check if the price history of this stock corresponds to your risk tolerance. If the price has been all over the place, it may be an excellent investment for speculators, but keep any money you can't afford to lose aside. Number 8. Ratios, P/E and D/E. The P/E and D/E ratios are two of the most important measures to evaluate before investing in any stock. The price-to-earnings ratio of a corporation is represented as a P/E. This is the ratio of the current stock price to the total profit or earnings per outstanding share of the corporation. So if a company's stock sold for $30 and it earned $2 per share, its P/E ratio would be 15. In a word, the P/E ratio indicates how much investors are ready to pay to have access to each dollar of a company's profits. In our previous example, this means that investors will spend $15 for every $1 in profit made by the firm. The greater this ratio, the more secure investors are in the firm. Most of the time, a ratio of 14 to 20 is approximately suitable for most equities. A smaller ratio may signal those investors believe the firm is in jeopardy, while a greater ratio may indicate that the stock has become overpriced. The debt-to-equity ratio, DE ratio, is a company's debt-to-equity ratio. This is the amount of debt the firm owes concerning its total assets. The DE ratio is calculated by dividing the company's total liabilities by its total assets. A corporation with $100,000 in liabilities and $1 million in cash and other assets, for example, would have a DE ratio of 0.1. This score might show how hazardous an investment is in general. A lower DE ratio is often seen as a safe option since it indicates that the company's assets outnumber its liabilities. A high DE ratio indicates that the firm has a lot of debt related to its capacity to pay, whereas a DE ratio greater than 1 indicates that the corporation has more liabilities than assets. High DE ratios, usually anything above 0.3 and 0.5, may signal a corporation ready for growth, having borrowed substantially for expansion, but they're more commonly indicative of a high-risk investment. Thank you for staying with me till the end of the video. I hope you enjoyed it. If you did, like and share the video. You can leave your questions and thoughts in the comments section below. Don't forget to subscribe and hit the bell icon to get notified when we add new videos in the future. Goodbye.